The numbers you see at the right hand side of this screen of this particular chart are called prices. These are candlesticks, and every candlestick is telling a story on the chart. When you see a long candlestick like this, it is called a Marabuzo candlestick. It represents volume in the market chart. What is another block? Another block is when a little candlestick is overshadowed by a longer candlestick, a bigger candlestick. For example, this is another block. As you can see, this little candlestick here is overshadowed by this long candlestick. An example of other block is this. As you can see, this little candlestick here is overshadowed by this big candlestick. So other blocks comprises of two candlesticks, a small candlestick that is overshadowed by a longer candlestick, as you can clearly see here. This is another example of another block, two candlesticks. This black candlestick is overshadowed by the green candlestick. This is also an example of another block. The bullish candlestick, which is the green candlestick, is overshadowed by the black candlestick, which is the bearish candlestick. When the market price is coming downwards, the bears are in control. That is the sellers, and the sellers are represented by black candlesticks. When the market price is going upwards, the bulls are in control. That is the buyers are in control, which is the candlesticks are represented by green candlestick. You can change the colors anyways. What is a fair value gap or an imbalance? When the market price is going upwards and it creates three candlesticks like this, and between the candlestick by the right and the candlestick by the left, there is a gap. That gap you see there is called fair value gap. That is FVG, or imbalance, or if inefficiency. As you can see, there's this bullish candlestick here and there's this bullish candlestick here. This bullish candlestick by the right and the bullish candlestick by the left. If you check, this is the wick of this candlestick, and this is the wick of this candlestick. What is at the center? A space. That space there is called imbalance. All right. A candlestick comprises of two things: the body and the wick. The line you see here for this particular candlestick, the line you see there is called the wick, while the body you see here is called the body. So a candlestick has a wick and it has a body. All right, a candlestick comprises of wick and body. They are what we call patterns. Every candlestick, like I said earlier, is telling a story, and the candlesticks can come together to form a pattern. The multiple arrangement of candlesticks are called patterns. For example, this arrangement now is a pattern, and what pattern is this? It's called head and shoulder pattern. Look at the shoulder and look at the head. Anytime you see this pattern, the head and shoulder pattern, know that the market is about to come downwards. This is head and shoulder pattern. Now, how do you trade head and shoulder pattern? When you set head and shoulder pattern, you identify the shoulders and you identify the head, and then you ensure that the second shoulder, the bottom of the second shoulder, is not longer than the bottom of the first shoulder. Bottom. You understand? This is the bottom of the first shoulder. Yeah. It's not actually the bottom of the first shoulder, but it is the bottom of the head. But you get the point. Yeah, the bottom of the head. This is the particular bottom of the head. Ensure that this particular low that creates the second shoulder is no longer than the previous low of the head. Just ensure that, such that when you draw a line like this, it's the shoulder here. The shoulder here is no longer than the low here. The low here is no longer than the low here. It should be either equal, or this particular low should be lesser. That is, it should go inside like this. Now, when the market price breaks through this line, you should mark the other block you see above in the 1 hour time frame. Always use 1 hour time frame or 30 minutes or 30 minutes time frame. Now, this is where I want you to understand the most. Take note of the low, the particular low. This is a low. This is the low that created the shoulder. This is the low that created this shoulder. Now, the purpose of head and shoulder is this: the market is going upwards, right? Then it came downwards. It tried to go upwards. It tried to create another eye. It tried to create another eye here, but it failed. It tried to create another eye, but it failed. It only got to this extent, and then it came downwards. It only got to this extent, and then it came downwards. Now watch what happened here. This is where your trades would make your trades very accurate. The market created a low here. It went upwards, tried to create a higher eye above the previous eye, which is the head of the pattern, but it failed. It came downwards. Look how it came downwards. It came downwards with a volume. Did I not mention a candlestick that is called a Marabuzo candlestick that carries volume? Ensure that the candlestick that comes downwards and breaks this low carries a lot of volume, like this particular move. Sometimes it might be more than one candlestick, but just ensure that it is consistent. The candlesticks that comes downwards are consistent. Black candlestick, like consistently, just like these two candlesticks now. These two candlesticks, black candlestick, they will come downwards. They will come downwards straight and break through this particular low. Whenever you see the particular pattern happen, know that the market has created a supply zone here. And if it has created a supply zone where it formed an OB, this is another block also called OB. If it created a supply zone, it then means that the market will surely go upwards most of the times, tap into the other block, and then come downwards. Right, this is how head and shoulder is. So always look for this head and shoulder. It's very powerful. The important thing is the last low that tried to create a higher eye, but it failed, and they created the shoulder instead. Ensure that it is broken with good volume, consistent black candlesticks. All right, or just one long black candlestick, but ensure that it is two. Even if it is one candlestick, ensure that you don't enter after this long candlestick. No, you don't set your limit after this long candlestick. Don't. You wait for another candlestick to form first before you set your limit, because you can set your limit and then you discover that the market will then go upwards with the next candlestick will overshadow the black candlestick, thereby creating another other block. Then it will then remove it from the market. Now, what is liquidity? Liquidity is basically I've talked about stop loss earlier. Wherever there are stop losses, that's where liquidity is. So we retailers, we are not the banks, we are not the institutes, we are not the big guys. So anywhere there are stop losses, where our stop losses are, that's where liquidity is. And liquidity is equal to fuel. Liquidity is the fuel that the market needs to move. So wherever there are stop losses, like that is our stop losses, we the retailers, the small guys, that's where the banks, the institutes, they target, so that they will have the enough liquidity, the enough fuel they need to enter a particular position. Let's say you go to a store and then you say you want to buy 10 carton of Indomie, but the store only has 2 carton of Indomie. So there's no enough liquidity in that store to get what you want. So you have to go to another store where they have 10 carton of Indomie, right? That's the same thing for the marketplace. There are people who trade the market with very big volume, big capital, like the banks, the institutes. They can't just enter the market like that. So what do they need? They need liquidity, they need fuel. And for them to get the fuel they need, they will have to target our stop losses with the small guys in the market. When they target where our stop losses are, then they will have the fuel they need to open a particular position. Now, how do you locate where liquidity is on the chart? Liquidity is located where there are relatively equal lows like this, or relatively equal highs, like this. So liquidity is seated below relatively equal low and above relatively equal high, or equal low, below equal low, or above equal high. Understand? That's where liquidity is. So anytime you enter a trade, always target where liquidity is, because that's where the big guys are targeting. The big guys they always target liquidity. So anytime you open a position, your take profit price should be targeted at where you know the big guys are targeting, which is liquidity area. Now, I'm about to teach you my strategy now. The reason why I taught you head and shoulder strategy first is because you need that to better understand how the strategy work. The way I trade the market is I trade the market based on exhaustion. When the market has gone upwards for quite some time, it gets to a point where it gets exhausted, it gets tired, and it has no other choice than to come downwards. So also when the market has come downwards to a certain to an extent, to a great extent, it gets tired, it gets exhausted, then it has no choice than to start going upwards. Exhaustion, think about it. The market always gets tired. You have to be very patient for the market to be tired, and then you start looking for entry. Now, when the market is tired, how would you know the market is tired? It will start consolidating. You know what consolidation is? It's when the market is ranging like this. When the market is moving upwards, when the market is on an uptrend, it start creating a lower, higher highs, higher lows, higher lows like this. When the market is on a downtrend, it starts creating lower highs, lower lows, lower lows, lower highs, lower highs, lower lows like this. But when the market is ranging, it consolidates like this. This is consolidation. No matter where it's going, it can be consolidating upwards like this. Consolidation. All right, that's ranging as well. So when the market is tired, as you can see here, the market went upwards to an extent, and when it got to this particular point, it got tired and it started the range, it started consolidating. That's to tell you that it got tired at that point, it got exhausted. So at that point, that's where you should be looking for your entry. Now, how do you look for your entry? This is how you look for your entry. You wait patiently for the market to create an head and shoulder pattern, like I earlier explained. That this is why I had to build this. I had to do a build up to the particular strategy. Look at this. The market created a head and shoulder pattern. Perfect. As you can see, this market created a head and shoulder pattern perfectly. First shoulder, head, second shoulder. Now, this is how you should follow up this kind of market. When the market creates the first shoulder, it will come downwards and create a low. The low it creates that initiates the move to create the head, you mark it with a line. All right, the low it creates that initiates the move to create the head, you mark it with a line. Then after it creates the head, it will then come downwards and then create a low that then creates the second shoulder. Now, this is what I was talking about earlier. This second shoulder that was created, the low it created before it created this second shoulder, ensure that it is not below the previous lows. This is the previous lows, 1, 2. This one is the Oga Patapata of all the lows. Or it is the low that was created after the first low was created, after the first shoulder was created. So just ensure that this second shoulder, before it was created, that low it created before it created the low that was created before the second shoulder was created, ensure that it is not longer than the previous lows. It should be inside, be shorter. As you can see, if you draw it now, if I draw a line there, now you see that it's shorter. All right, ensure that. Now, secondly, ensure that this particular low that was created before this second shoulder was created is broken with good volume. consistent black candlesticks. Not that you will see a black candlestick and then you see a bullish candlestick and then you see a black candlestick. No, consistent black candlesticks, consistent. And before it breaks through this particular low with consistent black candlesticks, it has to create an order block first. I already showed you what order blocks are. It has to create another block first. So as you can see, it's created another block first. This is the 1 hour time frame. It created another block first before it then broke through this low with good volume, 2 consistent black candlesticks. So anytime you see this thing happen, the market breaking through the low of the second shoulder, with good volume, with consistent black candlesticks, you should know that the market has created a supply zone in that order block area at that moment. And you should be expecting the market to go back upwards to tap into that order block. And when it taps into that order block, it will come downwards. As you can see, it tapped into the order block, and what did it do? It came downwards. Where should you target? Anytime you are targeting an area for profit, the place you should always target is where liquidity is. And what are liquidity? I already explained to you. Liquidity is where the retailers' stop losses are. With the small guys, is where our stop losses are. And how do you identify liquidity? Liquidity is located where there are relatively equal lows, below relatively equal lows like this, or relatively equal highs like this, and those are where our stop losses are like this. Now this place contains relatively equal lows, so there are stop losses here, our retailer stop losses. So the big guys, the institutes, will target this place where there are stop losses, where there are retail stop losses. Why? Because they need this fuel to open their own position. Remember, liquidity is the fuel needed for the market to move to a certain direction. All right, immediately the market grabs liquidity here. Now you see that it will then have the fuel it needs to reverse upwards. After it comes downwards to clear the liquidity here, it will then have the fuel to go upwards. That's because it has gotten the fuel. All right, so anytime, if I had taken this trade, I would have targeted. I did try to enter the market, but the market did not get to my the place that I'm supposed to take the trade, so it left me. So this is the area. Around this area I targeted. This is the place I marked for target. But where would I have put my take profit? I would have put, after I mark where liquidity is on the chart. After I mark where liquidity is on the chart, I'll then put my take profit mark above where the liquidity is. I'll look for an order block near this area. And then put my take profit above the order block. As you can see, this is another block. Small candle, long candle. The small candle is the black candle, the big candle is the green candle. This is another block, so I'll put my take profit above it. All right. In the 1 hour time frame, always has to be the 1 hour time frame or the 4 hours time frame. All right. Now, for precise entry, after you've located the supply zone, like I earlier said, after you located it in the 1 hour time frame or the 30 minutes time frame, so mostly use 1 hour time frame or 30 minutes time frame, but 1 hour is superior to 30 minutes time frame. So after you've located your supply zone, you then need to go to the 5 minutes time frame. This is very important. Go to the 5 minutes time frame and then look for an order block in the 5 minutes time frame. As you can see, inside the supply zone. So inside the supply zone that you've marked, you look for a 5 minutes order block. So as you can see, this is a 5 minutes order block. The highest one, don't pick the lowest one. Like as you can see, this is also another block, this one, but we are not going to pick that. We'll pick this highest one. So the one that is way above, that's the other block in the 5 minutes time frame that you pick, that is inside the supply zone. So where would I have put my entry point, or where is the right place to put it? You put your entry point at the center of the small candlestick in the order block. Order block consists of 2 candlesticks, the small candlestick and the long candlestick. So you put your entry price at the center of the small candlestick, then you put your stop loss above the general order block, which is in the 1 hour time frame, like this. This is the general order block. Look at where it stopped, and look at where my stop loss is. It's above the order block. And you can also determine that from the 5 minutes time frame. You can also determine, because you already marked it before you came to the 5 minutes time frame. So you can see, put your stop loss above, then you target where liquidity is. I already explained that to you. 1 hour time frame. So that area where there's liquidity, you look for an order block close to it, and then you put your take profit above the order block. So these are my strategies. I use exhaustion. The market has to be exhausted, and when it's exhausted, it starts consolidating, it starts ranging. That's when you know that the market is exhausted and it's about to come downwards. And when it's about to come downwards, you watch out for head and shoulder pattern. Or another thing is, the market would first of all, the market would create an order block. The market will create another block, tap into that order block, and then you won't enter the trade at that moment. You wait for it to create another order block, and the tap it is that second order block tap. Then you then look for, you then mark as supply zone. When you mark it as supply zone, like I earlier explained how to mark supply zone, you then go to 5 minutes time frame and then set your entry position. This is an example of what I just explained to you. A rough example anyways. You wait when the market starts consolidating. As you can see, the market has been on an uptrend for quite some time, as you can see. Then when it got upwards, it started ranging. Then you just wait. At this last point, you will see that it created an order block first. It went upwards and tapped into that order block. That's the first tap. Let me mark it. That's the first tap, the first order block that was tapped. 1 year. Then you won't enter at that moment. You wait for it to create another order block, which is, as you can see, it created another order block here. Then it is when it is coming upwards to tap into this second order block. That's when you then go to the 5 minutes time frame, look for another block inside this second order block supply zone, and then you set your entry. It doesn't really matter for you to, it might be that you won't see another block in the 5 minutes time frame, but anywhere you find, and like the last body, like I told you, a candlestick comprises of body and wick. So the last body, let's say you see a body here, like body, it's not even like it's not another block, like you see. This is how the 5 minutes time frame is. You put your entry price at the center of the last body of the candlestick in the 5 minutes time frame. So the last body, not the wick, the last body of the 5 minutes time frame. You put your entry price there. It doesn't matter if it's another block or not. You understand? So this is what I just explained. The market taps into the first order block once. You are not entering that. You wait for it to create another order block, and then when it's about tapping into it, you go to the 5 minutes time frame and look for an entry inside this supply zone. All right. Now, if you take a look at something here, you see that this is a low. This is a low. So before you enter any trade, you should take note that if the market does not break through a particular low with good volume is very important. Take note, volume. Say after me, volume. If the market does not break through a particular low with good volume, it means that when it comes backwards to that particular supply zone, no, it's not even a supply zone. When it comes backwards to that particular order block, it will not respect that order block. It would either break through that order block and keep on going upwards. No, let me not say keep on going up. Yeah, keep on going upwards, or it will break through that order block before it starts coming downwards. The reason is because it did not first break through this low with good volume. Look at this. Look at an example. Look, this is a low, and you can see how the market break through this particular low with good volume, with one candlestick. Like I told you, when the particular candlestick forms that breaks through the previous low with good volume, don't enter. Wait for the second candlestick to totally form first.
because it might be that when you enter at this second, when you set your limit, when this second candlestick has not formed, you will be surprised that the market will then go upwards above this black candlestick to form another block, a bullish other block, and then the market will start going upwards. Do you see that thing? So to avoid that, wait for the second candlestick to form, and you are sure that okay, the market did not overshadow this black candlestick before you then set your limit inside the supply zone. Alright, because anytime you see an order block form, let's say you see another block form like this, a bullish candlestick, a bearish candlestick, a black candlestick, a small black candlestick, and a bullish candlestick, green candlestick. When you see another block form like this, know that you should be careful. It might be that the market is about to go upwards. So other block signifies strength. It signifies strength. So when you see it show up, you should be careful. Alright, so this is why you shouldn't enter at the second candlestick, because when the second candlestick turns out to be an order block formation, a bullish order block like this black candlestick now will then become the small candlestick, and then the bullish candlestick will then overshadow it. This is bullish candlestick. This is bullish order block. Look at bullish order block here. A small bearish candlestick and a long bullish candlestick. This is a bullish order block. The bearish order block is a small bearish. It's a small bullish candlestick, green candlestick, and a small bullish candlestick, green candlestick, and a bearish candlestick. A short bullish candlestick, that's a green candlestick, and a long bearish candlestick, that is a black candlestick. Alright, this is a bearish order block. Bearish order block is a short bullish candlestick, that is green candlestick, and a long bearish candlestick, that is a black candlestick. This is a bearish order block. Then a bullish order block is when a short bearish, that's a black candlestick, forms. Then a long bullish, that's a green candlestick, forms. This is a bullish order block. So when a bullish order block forms, know that the market might be planning to go bullish, that is, might be planning to go upwards. Remember, when the market is going upwards, the buyers are in control. When a bearish candlestick forms, it might be that the market is preparing to come downwards. Bears are about to take control. And look at what happened after the second order block was tapped. Market came downwards. Boom. And let's look at where it targeted. It targeted liquidity. Where's liquidity? Look at this set. Does that not look like liquidity? Yeah. It looks like liquidity because these are relatively equal lows. Yeah, you can say they are relatively equal to an extent. Oh, there's liquidity. The liquidity. Look at this side. Look at this low here, this small low there, and look at this particular low here. Do you see how relatively equal they are? You see it? You see how relatively equal they are, this here and this. So that's where the market targeted. And immediately it targeted it, watch what happened. You can see it targeted it with good volume. Then it reversed upwards, it retraced upwards before coming downwards. So these are the two ways to enter a market: head and shoulder pattern, or you wait for the market to create two other blocks. Alright. So I mostly trade sell model. I mostly trade sell. I don't trade bullish buy model for now. I don't trade buys for now. I only trade sell mostly for now. So this is how to trade. The main stuff is this: order block, OB, fair value gap, which is imbalance, the head and shoulder pattern, market, exhaustion. Yeah, you need to understand how to make use of consolidation. When the market is exhausted, it starts consolidating. So this is all for my strategy. and your class is over, ensure you watch some other videos I will send to you, like time frames, market structure and its components, it will further brush you up. And if you want to, you can read the candlestick PDF I'll send to you if you wish. But this particular video contains everything you need, to an extent. Yes, not to an extent, to a great degree. So your class is over. Thank you so much. My love.
Jesus said, "Take heed, therefore, that the light which is in thee be not darkness." When a room is dark, you use light to find your way. The light helps you to locate your path, your direction, and you don't stumble. But Jesus is saying, be careful so that what directs your path in life is not an evil desire. That's what it means for light to be darkness. Be careful lest what define your choices, what determine your decisions are evil desires. You see, every day you are going to make decisions, you're going to make choices. But what is driving all that? If it is an evil desire, at the end of it, sin is produced, which will, among every other consequence, attract an eternal punishment at the end of your life.